Hello, Jim here. Today I want to talk about how trading options can really be a great way to make extra income. And probably the most important part of trading options is actually how you manage the trades. It can have a significant impact on how much money you make per trade as well as how much you make on a monthly basis. I want to share with you the many different diverse ways I manage my trades. And at the end of the video, so be sure you stay till the very end, I'm going to share with you all the positions I've had in the last 6 months that went against me and what's happened since they went against me. I think it'll be kind of surprising to you. So I definitely think you should stay until the end. So with that being said, let's go ahead and jump right in. Okay, I want to take a few minutes just for a quick history of my experience when I first got started. So I started trading options probably 15 years ago. I was only doing covered calls. There was very little literature out there. I don't believe there was anybody on YouTube at the time. To get started, I actually found a book at Barnes & Noble, and I found a few interesting chapters that kind of led me down the direction about covered calls. I wanted to find a way I could make some extra income. And then what I did is I actually worked with Schwab over the phone. They actually directed me and showed me how to set up my first covered call. So that was the very start of my journey selling options. And I did that for, once I learned the basics, I did the same type of trade probably 10, 12 years. It was primarily covered calls, and I would pick a stock price. It was about 10 to 15% above where Coca-Cola was at the time. And then I would just sell a covered call. I might go out 2 months, 3 months, 6 months. Sometimes I go out a year or two. And it worked out quite well. In many years, I had nothing assigned away from me. But then about 4 years ago, when I started this journey that I'm sharing with other people, I did get assigned. I think I had 4 or 5 contracts assigned away, and it had a pretty big impact on me. I decided I really didn't know what I was doing, and there was a lot more I could learn. So I looked out, I tried to find podcasts. I did find a podcast or two that talked about selling options. And I did find a blog or two, and then also a YouTuber that I started watching early on. I'm not sure he's even doing it anymore, but I learned a bit about from him. And then I kind of just went on and started to learn different things and started to improve on my process and improve the way I did things. But I'm one of those people that I don't make huge changes. I'm like the captain of a cruise liner. I make small modifications, slightly change the direction. I don't do huge changes. Now, I decided, I believe 2 years ago, that quarterly I wanted to try a new trade. I wanted to try something different to see how it worked out. So I like doing that. I do that currently with some of my wheel trades, if you guys are following me with my wheel trades. But for the most part, not much changes. I don't do any kind of crazy trades. I don't, the wheel is still a fairly safe trade. And then, once I learned the basics and I learned how to do some basic management, then again, like I said, I just made small modifications here and there, and it made a big difference. Now, probably the biggest, most important point, and I keep sharing this pretty much in every video, is it comes down to picking the right companies at the right price, and price does matter. There are a lot of traders who are momentum players. I'm not. I'm a fundamental person. I find it very difficult to pay crazy amounts for a stock, 150, 200 PE. I do believe any company that's that overvalued will drift back to the mean. It'll come down if it's that pricey. And then what I like to look at fundamentals. I like to look at ROE, ROA, debt to equity. I also like to look at year-over-year earnings. I like to learn a little bit about the company if I don't know much about them. I like to look at their products. I'll go out to their websites. If it's a software company, I'll download their software. I'll give it a try, see what it's like. So I've learned to dig deeper to get a better feel for the different companies. And if you don't pick up anything else from this video, that's probably the most important thing. So I just wanted to start out with that and the fact that I really don't do anything extreme. I'm very risk averse. I take things very slow. I only do a trade or two a day. Some days I won't do any trades. Others I might do 3 or 4, especially if I'm closing some positions. But typically it's between 1 and 2, usually around 30, between 30 and 35 trades a month. And it's very part-time for me. I spend more time sharing my trades with my communities. If I wasn't sharing my trades with my communities, I probably would spend maybe 30 minutes, 40 minutes the whole day trading. But the fact that I do share things, and now I've gotten a pretty active community and membership. I have a lot of people also sharing their trades. I just made a change to the Discord this morning related to, I added a discussion area for crypto and Bitcoin and that kind of stuff. But we talk about a lot of things. We talk about, setting up an LLC or an S corp in order to trade, or, also learning tools. There's some pretty active discussions going on about different tools that people could use. I like Seeking Alpha. I also like Barcharts. They're the two I'm currently looking, but if I have time, I also like to look at other companies. So just a quick overview. And I do provide to my community this planning worksheet. I just released it this morning, made some updates, some changes. It was actually a recommendation from one of my members that I added some changes to the spreadsheet. And I've done that quite a bit. If members come up with a good idea and everyone's in agreement, then I'll make changes. So in that planning worksheet, I start planning probably 21 days out for any trade. I keep an eye on everything. All my trades are in my planning worksheet. I usually have around 80 positions. Usually half are covered calls and the other half are cash secured puts or vertical put credit spreads. I might have 1 or 2 iron condors mixed in. And I'm trying to stay right around that 80 positions. It works out quite well for me. So next, I'll jump into the key ways that I like to manage my trades and how it can really it can make you or break you. And surprisingly, if you manage them the right way, it can be a godsend. So let's jump into the next section. Now, my main focus is probably more on vertical put credit spreads and cash secured puts, but a lot of this also applies to covered calls or if you're doing call spreads. So a lot of times, I will allow the position to expire. So I believe I have 8 or 9 different ways that I typically manage. But, if something is way out of the money and I have plenty of cash and I don't need to put that capital at play again, I will allow it to expire. I had probably 4 or 5 positions a week ago, Friday, 11/15, that expired. I could have freed up the equity, but I didn't really need to because at that point I could not find other positions that I would rather have traded or gotten into at the time. So what is it? If it expires, it's just passes expiration and you get to keep all your premium. So if it's out of the money, there's no need to spend extra money to close it. Now that doesn't, the next part you'll see talks about closing, but I do close a lot of my trades too, especially if I can close them way early. When to use this? Near expiration with no realistic chance of option moving in the money. So the near expiration is pretty key. If you're pretty close to expiration, why spend some extra money to close it? Just let it, pass through expiration in a lot of cases. An example is a $50 put on a stock trading at 80 with 2 days left, and just let it expire worthless. It's so far out of the money. Now, the other one, which I've been doing a lot more of, is closing my positions, especially if I can close them 30, 60, 90 days early, I will. So typically, if it becomes very profitable, there's very little premium you can make at that point, meaning you've already made most of the premium you could potentially make. So I would close to free up capital and to improve my buying power, meaning if another trade comes along, I freed up that cash and that buying power to be able to make that trade. So when do you use this? If you can close the trade for less than 5 to 10%, I get even cheaper than that. I've closed trades for $2 or $3. I do have other members and a lot of people who are more hardcore traders that will close as high as 50%. So you could go the other extreme, meaning you do a lot more trades, but you close you get a 50% profit and you get out. So if you're a pure trader versus an investor like I am, that's something you would potentially want to do. Again, I'm picking these companies and typically picking strike prices where I really want to own them. So I don't necessarily want to get out of them. Some of my biggest mistakes is getting out of a position when it was going to be assigned to me, and I might have picked up that stock at a great price. I've rolled myself out of owning a stock at a great price. An example, you sold a put for $1 and it's now worth 5 cents. There's no reason to keep it, just for 5 cents. Maybe you could save that 5 cents, but in a lot of cases, that's, not the case. Now, this seems like cut, black and white, but it really isn't, because a lot of times a trade, until it gets pretty close to expiration, has a lot more theta, and theta is just kind of the measure of how much it's decreasing on a daily price, or not daily price, on a daily basis. So as you get closer to expiration, it becomes a little bit clearer, and that's when you can decide if you want to let it expire or to close it. But if you have earnings and stock shoots up, then it can become very profitable. A lot of times right after earnings, if I already have positions in a company or ETF, I'll go ahead and close them. They'll suddenly become very profitable. Roll the position. So this is to extend the duration of the trade. You're picking a future date, and then I typically try to improve the strikes if you can. A lot of times, though, I'll just roll to the same strikes, especially if they're still fairly far out of the money. Now, rolling is just a fancy term. You're closing one position and opening another one, and the new position is paying for closing your current one. So a roll doesn't necessarily have to be at the same time. Some of my best, most profitable trades are when I've closed it, and then a couple weeks later I opened a new one, versus doing it all right at the same trade. It's kind of like a delayed roll. Why do this? Bring in additional premium. I do like to try to get at least 100 for each contract if I'm rolling, and then if I can make a better, more favorable condition. But again, I go back to looking at the stock. Why did I? Is it already at a good price? Again, do I want to own this? I'm typically, being an investor, a lot of times, again, I want to own these stocks. So, and keep the position alive if you're bullish or waiting for a recovery. When to use this? If the position is slightly in the money or near break even, and you want to avoid assignment. So if maybe you're just slightly in the money or just slightly out of the money, and you're getting near expiration, for some reason you don't want it to be assigned to you, that's when you potentially would use it. Now, it becomes more and more difficult the deeper you are in the money for rolling. So at times, if you're very deep in the money, you might not have any choice. You might not be able to roll, or you might have to take a little bit of a loss to buy yourself more time. Or potentially try to lower the strike prices. The other thing you can do when you're rolling is, if you've done a $5 spread, you can roll to a $10 spread. So, you're taking less risk or more risk, because you're widening that spread. So you're upping your potential losses, but you're able to bring in more premium from the future trade to hopefully lower the strike. So if you're trying, say it's 40-30, you might be able to do, go down $2, but, slightly widen the spread between the long and short. So just something to keep in mind. An example is rolling a $40 put expiring this week to a $39 put expiring in 2 weeks for additional credit. And then next is allow assignment. And this is, like I said, I probably have made more mistakes not allowing assignment. I had a lot of this early on with Apple. I could have picked up Apple at a great price. Also Google, also I think even NVIDIA. So just allowing it to be assigned. If it's in the money at expiration, it will be assigned to you. Early assignment's slightly different, so we'll talk about that here in a minute. So why would you do this? If you're comfortable owning the stock, At that strike price, this can be an opportunity, to acquire a great company at a discount. For long-term investors like myself, assignment is often part of the plan. So, if you look at it, if you're picking a stock, again, I'll use Coca-Cola, and it's currently trading at $65. But you say, well, I'll sell a put on it. I'll bring in, $150, but I want to own it at 60. So your strike price is at 60. If you get assigned, you're still doing better than if you had purchased it at 65. You were assigned at 60, but you also brought in some income. So if you brought in $100, your cost basis would be 59. So, overall, you're doing even better than you would have done if you had just purchased the shares. Now, what happens is with trading options, people, and including myself, you look at the stock so often at the options that it's hard to look back, and that's why I like to keep a journal, to keep an idea of why you made the trade. And this is what I provide with all my trades. As I post them in Patreon, and I also post them in Discord, so people can go back. They can see the history as well as myself. I go back and I look at the history of why I made that trade, and it can make a world of difference. It can lower your risk, at least your mental risk, because you're like, wow, it's dropped 5-10%. But if I had bought it back when I first put this position in, I would have paid even more. Because again, stocks, they go up and down. If earnings are good, it shoots through the roof. But then, over time after earnings, it typically drifts back down. And the reverse is true. If they have bad earnings, they get hammered and they tend to drift back up. Unless it's a problem child, unless it's what I like to call a dog, and it's hitting lower lows, meaning like Walgreens. Walgreens has just been hammered between all the theft and allowing people to steal whatever they want in the stores, and all the stores that are being closed. That's the exception to the rule. But in most cases, every time I've had a Walgreens, I probably have had 2 or 3 others that I would have done better had I picked up or allowed the assignment to occur, where I ended up owning those shares. So when to use this, when the stock is below the put strike and you're happy owning it. Example, selling a 125 put on UPS. This is a real example. And being assigned shares at 125, even if the market price is slightly lower. UPS is one of those examples where that happened, and now it's higher than what it was assigned to me. Plus, I've been selling covered calls, and I sold the long put, but we'll talk about that in a little more detail here in a minute. So another choice is what I just mentioned. You can be assigned, and then sell your long put. This is for early assignment. So if the stock dives, it's fairly deep in the money, and the shares get assigned to you, one choice you have is to sell that long put and then use the cash from that to lower your cost basis. So what is it? What is it? After being assigned shares, sell a long-term put to offset the cost and reduce your effective stock price. Why would I do this? Again, lower your cost basis further while maintaining the potential upside of the shares, and then generate additional premium while holding the stock. After being assigned, so when to use this again, after being assigned and wanting to hold the shares while reducing risk. And here's another example. This is also, I don't know if the numbers are exactly right, but assigned Airbnb shares at 130, then selling at 125 long-term put to offset the cost. So I had a 130. In this example, they were assigned to me at 130. I sold to 125, picked up the cash, and use that cash to lower my cost basis. So I ended up picking up Airbnb even lower. So again, these numbers aren't exactly right, but we'll talk about the trades at the bottom here. And next opportunity or choice you might have is roll to a different stock or ETF. I have tried this. It has not worked real well for me. It's probably because I haven't tried it enough. If you're rolling to a company that has great premium, an example that comes into play, which I forget to do this, if it's a stock you don't want to own, try rolling it into NVIDIA, or try rolling it into something you really want to own that has a really good premium. Like I said, I've tried this a few times. It hasn't worked out. So why do this? If the original stock no longer fits your trading plan or premium drives up, this can be your capital, or will keep your capital working, and then transition into diversified ETF. So you could potentially, roll out of a stock into an ETF. And that's something I did try. So an example would be rolling from a stock like Palantir to an ETF like QQQ with better premiums. Now that's kind of not the best, because QQQ is what, $400 or $500 a share, and Palantir is like 60. I would look at something more like NVIDIA potentially. Next is close a long position and convert to a cash secured put. And I did this with Dell. So this is another one that I did. So I exited the long spread position, meaning I had a vertical put credit spread, and I sold the long put, and then I rolled into a cash secured put. And I was able to bring in a lot more premium. It was almost shocking. I think I brought in $400 or $500 in additional premium. So why do this? Simplify the trade and collect higher premiums from the cash secured put. And then useful if the underlying stock looks stable or slightly bullish. When to use this is when you've earned most of the spread's value or volatility has dropped. Example, closing a long 50-55 call spread on Dell and replacing it with a 50 cash secured put. Now, again, the numbers aren't quite right. This isn't the best example, but I actually did this, and I'll talk more about it at the end of the video. But Dell has shot up. I think my cash secured put is pretty profitable. I'll probably close it because it's so far out of the money, but it worked out well. It would have been assigned to me, but being able to roll it by doing that, by closing the long position and converting it to a cash secured put, allowed me to do it. And that's also why I always like to mention vertical put credit spreads. You have more choices. If all you had was a cash secured put, you could not have done this. And I believe the long put brought in quite a bit of premium. So it was quite beneficial. Assigned to and from for a major drop. This is just if both sides of, or both, if you have a vertical put credit spread and both, you're short and long or in the money, then you can allow the assignment to occur, and then you can also call the brokerage, and I believe that's the only way you can do it, and actually put the shares to someone else. I have not done this yet. I'm actually thinking about doing it with one position currently, ACLS. They haven't been assigned to me yet, but actually they have been assigned to me, but I still have the long put. And I believe it expires December 20th. So I'm trying to decide what I want to do with it. What's key here, again, is looking back at the stock, and the EV market's been hammered hard. They make chips for the EV market. I'm trying to decide if they're going to come back or if they're going to hit lower lows. So that's what I'm trying to decide. I'm probably going to make a decision this week or the following week. I typically like to, if I'm going to sell a long put or put shares to someone, I want to do it with at least a week, 2 weeks before expiration. So what other strategies to consider? You can double down on premium if volatility increases. So yeah, you might be able to bring in some extra premium by potentially adding a second leg. I haven't, so if you have one contract, you may go to two. So you might roll the one contract, or you might close the one contract but open two, so that you can more easily close the one contract. Now, a lot of members, or not a lot, some members do this. I haven't done it yet. I've played around with it, but it is definitely, if you like the stock but you just think you're just not ready to commit to it, it definitely is something you could do. Iron condor adjustments. It is a little bit more difficult to adjust iron condors. I had to adjust an iron condor recently in NVIDIA. It had shot up so much that I was able to call Fidelity, get them to break it up into its wings, so it suddenly became, two spreads, a call spread and a put spread. I closed the put spread because it was so profitable. And in the call spread, I rolled up. Now, I could have potentially rolled both up, but I preferred at that time just to increase the strikes for the long put, which I currently have. I think now with NVIDIA dropping, I think it's also fairly profitable, not quite profitable enough to close it. So, and then covered strangles. This is, again, something I'm thinking about doing. I haven't done it. Let me know if you guys have done it. If assigned shares, sell a covered call and sell a cash secured put below to create a double income strategy. I do know a lot of people do this too. So in the notes, let me know, or add a comment or leave a comment if this is something you do and how it works out. Has it worked well? And then how to decide which strategy to use. Just comfort level. At first time you do one of these, one of these management strategies, it's kind of new. It's a little bit odd, but once you've done it a couple times, it becomes second nature. I mean, I've had a lot of positions assigned to me over the years, probably 20, 25. But when you do a lot of trades, that's not that many. And then look at risk and reward trade-off for each adjustment. And then follow the market trend, bullish, bearish, neutral, deciding whether to roll or closing is better. The one other mistake I forget to mention sometimes is there are times when I wish I had closed. So, at first I rarely close, but I'm definitely closing more positions than I used to. So here's some of the positions that kind of went against me. So quick overview of assigned stocks. So this is related to over 120 put trades. So it's like 91.6 not assigned, and then 96.6% were profitable. So ACLS is kind of in play right now. And like I said, if I have the shares put to someone else, I'll end up with a $1,500 loss. And I believe the long put is worth around $20. So it'd be like I'd be owning ACLS at 90 because the current short strike is 110. So this one, this is still to be determined. I'll probably make a decision, like I said, pretty soon here. Now, Airbnb worked out really well. It's one that was early assigned, and then I sold a long put, and I sold a covered call, and Airbnb now is above what it was assigned to me. It's gotten quite profitable. So even though it was early assigned, it's worked out well. It's one I'm glad I picked up. UPS, also an early assignment, and I sold the long put, and just like Airbnb, it's worked out. And now I'm selling covered calls. And I've been surprised. UPS has pretty good premium on covered calls. And, with covered calls, you just need to stay above the cost basis. I am looking at potentially doing covered call spreads to limit, when a stock shoots up. And it's not always the software companies or the huge growers. Sometimes it can be a company like UPS. So, and the interesting part of a company like UPS is the fact that to buy a $5 out long call or a $10 out long call could potentially be really, really inexpensive. It's kind of maybe a no-brainer. It's something I'm definitely looking at because I've had instances where, and I currently have several that are deep in the money covered calls. They're profitable. They're way above my cost basis, but the stock has gone up so much that I wish I had done that. I wish I had done what I'm calling a covered call spread. So, you buy the long call side. So the only part you would miss out would be the spread itself. So if you had a stock that went from 70 to 140, and actually APP is a great example. It went from 110 to over 300. I think it's like 330 now. It's even crazier than Palantir. So Dell is the one I sold a long put and I rolled as a cash secured put, and it's currently way out of the money. So I'm probably I should have allowed it to be assigned because if I had owned Dell, I would have had 30, 40% appreciation at this time, but the trades were pretty profitable too. But definitely this is one of those cases I kind of wish I had allowed it to be assigned. Now this is Polaris, PII is Polaris, and I have had 100 shares assigned. I'm probably going to have 200 more shares assigned, but but I do believe they're oversold. I like the company. I think long term they're going to come back. So I'm going to take a short term loss, but I'm thinking within 6 months to a year, they're probably going to be profitable at that time for me. I think my cost basis is like 85 or 90, but they went down to, I believe they're below 70 currently. So ACLS and Polaris are kind of two of the ones that haven't worked out real well for me. Zoom is another one. It was assigned. It shot through the roof recently. So I'm glad it was assigned to me. I've been able to barely stay above how much it's gone up. So it's worked out. CVS, just like Walgreens, they've just been hammered. The theft, the fact that people can steal from them and they can't do anything about it, as well as some of the healthcare stuff has impacted them. But they're only like a 10% loss. At one point, they did pop back up and were almost not a loss. So I'm probably going to hold on to them. I'm not going to probably sell them at this point. Now, I may change my mind about that. Shopify is another one. It shot up. I've been having a tough time keeping my covered call above its currently, but it's got a really good profit. So again, that one was assigned to me, and I'm glad it was. The only mistake I've made at this point is, like I said, I should have probably done a covered call spread versus just a covered call. Now, Walgreens is probably the only one I'm going to sell before the end of the year. It's in my taxable. It was assigned to me. I was actually at Disney, and I was going to a conference, and I came down with COVID, and I went to the local Walgreens and had a really good experience with them, with being taken care of. And I just thought, wow, Walgreens, it's just way underpriced, which was a mistake. It's been hit so hard with the crime and other stuff going on. So this one, I'm definitely going to be taking losses here shortly. I'll take the losses against other gains. And then Path is kind of a mixed bag right now. It was assigned to me, and it looks like it got up above 14 recently. I believe if it goes above 15, I'm pretty close to being profitable. But one good earnings report from those guys, they were in the 20s before. I could see them shoot up back into the 20s, and suddenly it becomes very, very profitable again. So if you look at all these, I mean, I've had, after doing 120 put trades, and probably 90% of those are vertical put credit spreads, and then 10% are cash secured puts. I've only had really, 4 that have truly gone against me. This, you could say 5, because this one is still not profitable. But, you're going to have that kind of stuff anyway. If you're an investor and you own the stock, it's not a straight line. I can look at Coca-Cola. I'm so used to Coca-Cola. I know when it's been overbought. I also know when it's been oversold. Recently, I think a month or two ago, I mentioned Coca-Cola's overbought, and it's dropped back down. And I can also see that with some of these, like CVS. That's why I'm keeping it. Walgreens is a different matter. It could half from where it is now. Potentially same thing for ACLS. So I'm trying to figure that out and what I want to do. So that's what I wanted to share with you guys. Hopefully I didn't get too wordy. As always, please hit that like button and subscribe. I'm trying to get the word out. I want people to understand that they can really bring in some really good extra income on a monthly basis. It can have a big impact on becoming financially independent and retiring early. So again, thanks for taking the time to watch the video, and look forward to seeing you next time.